Good afternoon, ladies and gentlemen, and welcome to the next instalment in the Admiral Markets Trading Spotlight webinar series. My name's Paul. I'm here to be your guide today as we give you an introduction to understanding what are the safe haven assets. As always, I appreciate we have a broad range of people who come and join us for our Trading Spotlight webinars, from people who've been trading for 2 weeks and who are very new to people who've been trading for 2 decades and have a great deal of experience. So, it would help me enormously and help us if you have experience of understanding what safe haven assets are, if you actually even trade them yourself, if you could pop them in the chat box, that would be most appreciative. If you're watching this on YouTube later on demand, then great. It's great to have you here. If you like it, give us a like. If you've got questions, pop them in the chat box there. Stay with us till the end, because what I'll be doing is I'll be switching across to the live markets, and we'll have a little look at understanding how safe haven assets appear in the Admiral Markets MetaTrader 4 and 5 platforms. So what we're going to talk about today on our agenda, well, not unsurprisingly, what is a safe haven? That might be open to interpretation. Some people's view of what a safe haven might be different from others. But today we're going to give you a little bit of an introduction to understanding safe haven assets, and really, why is it important for traders to understand them? What is it that gives them their power in the market? What is it that makes them sort of people sit up and take notice of them? And not unsurprisingly, we want to talk about, well, how can traders use them to their advantage? That's what you're here for. And hopefully, as I said, we'll have a little bit of an introduction, a little bit of understanding of different types of safe haven assets, so that you are better understood, in terms of better prepared to basically engage with them in your own trading endeavors. So for those who don't know me, my name's Paul. I've traded for many years. I coach traders across the spectrums, and primarily I look to trade FX indices and commodities, looking to be a trend trader for my swing and longer term positions, and a mean reversion and reversal trader on shorter term frames. That's the way I like to engage with markets. And we're here, to Admiral Markets. So as you can see, they're a Forex and CFD broker that provide many access to many financial instruments, big, wide, global sort of support mechanism, licensed and regulated across a wide range of regulatory environments, providing very competitive spreads for the most popular of trading products, and giving you the opportunity to access markets via the very popular trading platforms of MT4 and MT5. As always, if you have any questions about Admiral Markets, get in touch with your account representative, and they'll be very happy to help you. But let's talk about safe haven assets. Okay, so during volatile times, we hear lots of talk about safe havens, but what actually are they? Well, it's important for traders to understand what safe havens are and the role they play in markets. In doing so, you help yourself to treat them as an opportunity rather than as a threat. So in this session, we'll discuss the different types of safe havens and how you can engage with them as part of your trading. So a couple of you there have put in ideas of what you think are safe havens. So for example, thank you, Ronald. Thanks, Palmer. We'll put them. We'll mention them in a moment or two. But the key element there that I want you to take away is that it's important for traders to understand what safe havens are, okay, the role they play in markets, and in doing so, you help yourself treat them as an opportunity rather than as a threat. This is 2020. We've had a rather tumultuous, a rather interesting year. It's certainly in markets and every other aspect of our normal everyday lives, and of course, safe havens have been very, very popular. They've come to the forefront in terms for many people who wouldn't really have understood them in the past. So this webinar is coming at a good time to help you understand, what safe haven assets are. May also, as we move across to the charts, have a look at understanding how, order flow presented itself during this earlier part of this year, when the markets went a little bit volatile, a little bit wild, as the true impact of COVID started to hit the globe. So, when we look about, what is a safe haven, right? What we're looking at is it's a case of, generally a safe haven is deemed to be an investment that is expected to retain or increase in value during times of turbulence. not really a shock there. I would suggest to most people. What it is that traders and investors seek them out to limit their exposure to possible losses when markets turn downwards. And that is probably more relevant and more interesting to us, okay? Traders and investors seek them out to limit their exposure to possible losses when markets turn downwards. This is where it starts to become much more interesting and much more valuable to us as an understanding, as an opportunity. However, there are plenty of safe havens, and it's important to understand the context, and that's what we're going to do. We're going to talk about, understanding that particular context. But what I want you to realize at its most basic, sort of simple elements, is that safe havens tend to be, an investment or an instrument, okay, that traders and investors will flock to when markets start to turn down, okay, when markets start to sort of roll over, so that they're hoping to, have limit their exposure to possible losses, and possibly even just look at where they can sort of retain or even sometimes increase the value during times of turbulence. So, it's not unsurprising that, when markets turn down, as markets start to get risky, that is when people like to look for safe havens. Okay, the kind of clue is in the name, so to speak, ladies and gentlemen. So it is about being able to sort of recognize, well, what are those safe havens? And it's important to understand the context of them, which is what we'll talk a lot about today. But, because of that context, traders, investors, you must complete your due diligence, all right? It's not just a simple case of, X, Y, and Z are always safe havens. We always go there when there's a turbulence or there's a downturn. It's about understanding the sort of kind of greater like geopolitical global context sometimes. Not all instruments are a safe haven every time there is turbulence or a downturn. And it's important to realize that, ladies and gentlemen. So, when we talked about this, we had Ronald here. Ronald, he thought that the Japanese yen, gold, and similar were safe havens. Maybe, you can think about yourself. What do you think would be a safe haven? Okay, what do you think would be a safe haven asset, safe haven investment? Where do you think you'd be putting your money when markets get turbulent, markets start to roll over and turn out? Where would you be looking to place your money? What would you be? Where would you run to? What would be your particular safe haven? It'd be interesting to see if what you think is a safe haven and what I'm about to show you over the next few slides were one and the same. So Opera says bonds. Well, you might find out there. Thank you. Thanks for your interaction. Okay, we'll see what comes up in the next few slides. But yeah, thanks for your thoughts. So safe haven, or a safe harbor there, as we've got as you can see in that photo, is a safe haven helps an investor to diversify their portfolio. This is what good investors do as well. They are able to have their finger on the pulse in terms of what the market is doing, and when they see a committed and determined turn against them, okay, in markets, well, they're looking for ways to diversify their portfolio. They want to stem any possible losses, and where possible, as it says, retain or perhaps even increase in the value based on what particular safe haven they choose to move towards. That is not unsurprisingly is beneficial in times of market volatility. And, it's 2020. We have had a good deal of market volatility this year, ladies and gentlemen, in both good ways and bad ways. And I've talked all the way through the Trading Spotlight seminars and also on the Traders Yard, is that, it really is all about understanding, can you turn a threat into an opportunity? And, what we're very keen with here with Admiral Markets and the Trading Spotlight webinar series is that providing you with the education and the insight that allows you, okay, to start turning what may have been threats into possible opportunities for you. And, not unsurprisingly, as it says there, during a severe market downturn, like an economic recession, it provides a safe harbor. That is what savvy traders and investors are looking to do. And what you will see and what you'll understand, okay, is, as we go through these slides and look at some of the live markets, is that, savvy traders and investors, they are, as I said, they have their finger on the pulse, and any thought or any possible consideration that there might be, market volatility, turbulence, downturns, economic recession, well, then you will find that, okay, there will be a flow of money, a complete order flow that moves towards safe haven assets very, very swiftly. And that in itself can be a useful trading indicator for you. That can be a useful trading sort of signal in itself. So, not unsurprisingly, it says that a safe haven offers protection from market downswings. That's what traders and investors are looking to do. Okay, if you have done very well with your trading investment during the upturn of the uptrend, okay, well then you're not going to want to give it all back. What you're going to want to do is, if you see that the trend is over and the market's about to turn, well then you're going to want to find somewhere to basically place your resources until that kind of volatility and turbulence has passed. So with that in mind, why don't we have a talk about, some examples of safe havens there, okay? So a couple of people mentioned possible ideas a few slides back, but, we'll discuss them, we'll have a little look at them and sort of start to see which ones are actually viable, which ones are valid for you as private traders in terms of being able to add to your own opportunity list. So, not unsurprisingly, gold. All right, gold is seen as an example of safe haven, and you'll hear it very often mentioned. Okay, during times of volatility, during times of market turbulence, you will hear people talking about gold as as a very natural safe haven. And why is that? Well, as it says, for years, it's been considered a store of value, all right? And that's for thousands of years, okay? For thousands and thousands of years, gold has always been considered a store of value, and that continues to this day. And, we actually did a webinar just, it might have been about a month or so, 6 weeks or so ago, about looking about, whether gold was still valid as a long-term investment. And so, people will see that as, even though it's a safe haven, people will see that, okay, as an investment, because during times of turbulence, okay, during times of market uncertainty, as people move into a safe haven like gold and buy that, well, then invariably there might be capital appreciation in there. So not only does it retain its value, but it actually increases in value during those particular periods. What is interesting and and kind of key to us, okay, it is both a blessing and a curse for traders, is that its value is not impacted rate decisions. Some people might actually sort of disagree with that. Some people might offer a different viewpoint to that, but generally, okay, its value is not impacted by interest rate decisions, and actually it's just seen as a store of value. That store of value becomes more more valuable during particular times of turbulence or market uncertainty. So, what happens then is, during these particular periods of uncertainty, well, then, it serves as a form of insurance. And, that's what you could think about a safe haven as. It's a form of insurance, okay, for your investment portfolio. And what it will be is, a hedge against inflation because it's priced in US dollars, and that's what you will hear. People talk about it. Okay, they will talk about invariably. Once we see markets have that turbulence, those uncertainty, people will be buying into gold, okay, especially if there is a case of inflation, which means that your fiat currency, okay, starts to lose its purchasing power. Well, what will happen is that kind of will drive a move towards people buying gold, which means that gold price will accumulate, and it means that you've got yourself a particularly simple hedge against inflation. And I can say that some of the commodities may act as safe havens, but they're not as strongly correlated as gold. Okay, there is, not only is there a kind of a fundamental and a technical reason for using gold, but there's almost a kind of emotional, psychological, okay, requirement or desire to purchase gold when people feel that there is turbulence, market volatility, etc. It's as I said, it's been used as a store of value for thousands of years. That is kind of in our psyche, okay, in our psyche to have a store of gold of some way or form, okay, and so as I said, it's kind of almost like it's almost seen as like the natural safe haven, right? Whenever there is an issue or a problem, you buy some gold, whether that be gold coins, or whether that be a gold contract, as you'll find out, or whether that be actual physical gold in one form or another. But gold is the kind of prime example of a safe haven. So here's another example of a possible safe haven, and this is Treasury bills. Okay, sometimes as T-bills. So bonds, as as I think it was Opera sort of said earlier for Opera. Yep, thank you. That you were right. Okay, so it's a form of bond, a Treasury bill. Okay, it's an American version of a debt, of an IOU. Okay, so these are debt securities. All right, these are IOUs. Okay, it's a case of they're backed by the US government, are T-bills, which is what gives them their value. All right, because when people look for a safe haven, people always think the American government. Okay, the US is the biggest, most strongest, most powerful nation in the world at the moment. So invariably the US government is a safe haven of sorts. Okay, although that could be up for a huge amount of debate. But as a general rule of thumb, okay, debt issued by the US government is deemed to be that it will be paid upon. Okay, and they are unlikely to default, which means it's safe. Okay, it's a safe haven, and hence why those Treasury bills become very interesting. Okay, or very popular during particular periods of market turbulence and uncertainty. And if for those of you who remember, okay, go back, if we looked at the sort of certainly if we looked at the sort of great financial crash, so between 2006 and 2009, you will see there during the latter part of that, you will see that T-bills were enormously popular with all sorts of institutional investors. So, because of that, because it's backed by the US government, it's considered a safe haven in tumultuous times. Okay, people don't believe that the US government is going to default. People will believe that they will actually continue to pay their debts. US government, okay, they have the ability as the sort of the as the global power, okay, the global superpower, and also with access to the Federal Reserve to be able to create and print money, that they will always be able to just create and print enough money just to effectively to pay their debt. So that gives people a sense of security during tumultuous times, that if they buy T-bills, okay, they buy those bonds, that invariably they will be that money will be paid back. So they are effectively considered to be risk-free. Now, I would never say anything is completely risk-free, but in terms of probabilities, of default, as I said, it's very, very low. Okay, even at the moment, and so that gives investors that sense of security. That's what they're looking for in those tumultuous times. And any principal invested is repaid by the government. All right, and that's what's key. Okay, what you'll find is that during times of real market stress, okay, during times of real crashes, okay, is that you'll find that major institutional investors, they are they're not so much worried about making money. All right, they're actually just worried about keeping the money. Okay, people want to retain the value, and so putting money into T-bills, okay, the interest rates are normally very, very low, but in real tumultuous times, people are just more interested in firstly retaining their value. Okay, any benefit out of that, well, that's a nice to have. All right, that's but it's a case of living to fight another day. It's about getting through those particular tumultuous times. And as it says that during periods of economic chaos, investors tend to run towards them. And there has been an element of that, okay, during this rather tumultuous year that we've gone through. It's a little bit different because of various ways that markets have been manipulated, shall we say, over the years since the great financial crash. But nevertheless, there are still huge amounts of buying of Treasury bills, of T-bills. Okay, that is just still key for lots of, let's say, long-term investors when they find themselves in market downturns and tumultuous times. So One other sort of example of safe havens is defensive stocks. Well, what do we mean by that? Well, this is when market downturns occur. This is when invariably we get all sorts of manner of weird and wonderful moves in markets. It's investors move into stock sectors such as utilities, healthcare, biotechnology, consumer goods. All right, and these are seen as defensive stocks. Why? Well, because consumers are still going to need to purchase food, health products, and basic supplies, even in a downturn. If you think about that, okay, if I just talk about a personal experience here in the UK at the start of the challenges we had here with COVID, well, invariably what people were panicking about being able to buy simple things like toilet paper, to buy flour, to buy food. Okay, so to be able to get access to their healthcare products. Okay, so even during really tumultuous times, human beings, they still want to be able to get access to food, health products, basic supplies. Okay, basic supplies could be anything from from your gas to your electricity to these days might even be said to access to internet. Okay, so these are defensive stocks. All right, consumer goods. Okay, and savvy investors will look and identify particular stocks, okay, that are deemed to be defensive stocks, all right, that they can basically buy into in order to retain value. Defensive stocks generally, they don't, they are not a growth stock. Okay, they're not your tech stock, growth stock like like Amazon or Apple, etc. They are normally very run of the mill, very staid, okay, very slow moving stocks, okay, and people will buy them because the share price rarely does fall. They may also still continue to pay dividends, which basically helps big major investors. And as we said there, people still need access to food, healthcare, okay, and basic supplies even in the downturn. So there is still demand, okay, there is still demand for those products and services, and that's what savvy investors and traders are picking up on. And what can be said there is that, as more investors flow into them, well, their share price holds, benefit holds, or, you might actually get to see it particularly increase. So, here in the UK, if you looked at, there were here there were a couple of the supermarket stocks at the start of COVID. Okay, they did very well. Okay, some of the ones like we have Ocado, Waitrose. Okay, who had the ability to deliver food. Okay, sort of internet deliveries of food. Well, not unsurprisingly, okay, during the start part of COVID, if you look at their particular stock price, the stock price rose because people were buying into defensive stocks and people knew that there was demand. Okay, there was still demand, and that was what basically would held up their share price or actually help it increase somewhat. So, another example of a safe haven is cash itself. Okay, just basically holding holding your funds in cash. And, there is an old adage that when fear reigns, then cash is king. It's an old trading adage, and what that means is that when markets are going a little bit tumultuous, when markets are having there being great deal of volatility, well then for many people that actually the safest thing they can do is to be sat on the sideline with their money in their whether it be in a trading account, their investing account, their bank account, etc. Okay, where fear reigns, then cash is king. So cash is initially deemed to be a safe haven during a market downturn. Better to be on the sidelines in cash than actually maybe in a bad position in a very, very volatile stock or asset or instrument. But you also have to remember that cash offers no return or little yield. If you hold it just in your bank account at the moment, you're getting very, very little in the way of yield on your bank account, much less than what inflation is perceived to be. So you are going to take over a period of time, you're going to take a hit in terms of its purchasing power. However, the bonus for you is that actually that excuse me, that cash in your account is liquid. And you should be able to have access to it. Okay, you should be able to have access to it. People might say that might be a bit different these days, where we don't have as many you don't have as many banks on your high streets. Okay, most banking is done electronically, but as a general rule, you are liquid. Okay, in terms of having access to cash. Yep, and so as I said, there you go. It's not going to offer you, little in the way of return yield, and is impacted by inflation, which will eat into it over the period. What also you can look at is, some of the other safe havens are, particularly within markets, is one of them that we see is the Swiss franc, okay, the CHF, which we'll take a look at in a particular moment. This starts to become more interesting to us as traders. As the CHF, okay, the Swiss franc is considered a safe haven currency due to the fact that there is the perceived stability of the Swiss government. You very rarely see or hear about major sort of upturns or overthrows in Swiss government, unlike other nations or blocks that we particularly see, and that gives people a sense of security. The Swiss financial system, okay, for various reasons, is also deemed to be safe and stable. Okay, remember, we're looking for safe havens in what during periods of particular market stress, and also Switzerland itself has low unemployment and a high standard of living. And it normally always has a positive trade balance figure as well, and that's partly just because of stability, okay, and in terms of government and financial system, but also just their ability, the Swiss National Bank, to play a rather active role, shall we say, in that. It's also deemed to be a bit of a tax haven. Some people might say that's changed considerably these days, but nevertheless, okay, it attracts a great deal of inward investment, and also many people looking to effectively sort of hold their accounts there in Swiss banks. One of the other safe havens that becomes of interest to us is the Japanese yen, okay, JPY, which some of you may be active traders of already. So I find this an interesting one. This is personally, is that the yen has been considered a safe haven for decades, all right, and the yen historically has performed well during periods of risk aversion, and historically, it was also due to what was known as the carry trade, which does occur these days, but not in any way near the kind of the sort of volume that it was maybe 15 years or so ago, where invariably what the carry trade was really all about is that you borrow money in a very cheap currency, which was generally the Japanese yen, and then you bought a high yielding currency. Okay, so 15 years ago, okay, if you're a good trader, what you did was you borrowed money in Japanese yen, which was around about 0.5%. Okay, cost to borrow money, and then basically you put your money in New Zealand, where interest rates were 8.5%, and so effectively what you were gaining for is you're gaining 8.5% on your money in a New Zealand bank account, but of course you're having to pay out your 0.5% on the cost of borrowing the Japanese yen. So net wise, you'd be making about 8% a year on your money, which many active traders might say, well, Paul, that's not terribly exciting returns, but if you're a hedge fund or a bank or an institution and you're doing that on billions and billions and billions, well, I'm sure most of us would be happy to sit and take 8% interest on a couple of billion in the bank account. And very nice it was, and lots of you'll find lots of FX trading funds effectively just did that. And but since the great financial crash, where we've seen interest rates being really kind of suppressed, whilst the carry trade does go on, not in any way near the kind of shape and form that it used to, but historically it was very very popular using the Japanese yen because its interest rates were always so low, which made it a very cheap currency to borrow in. And one of the also things is, that Japan owns more than it owes. Okay, there's always a surplus there, and that's what makes it attractive to. Well, one of the things that makes it attractive to traders and investors. So invariably, what you will see is very often is that, when there is a particular event in the world, is that you will see, you'll see a spike in the Swiss franc and the Japanese yen, because the sort of traders, investors are looking for safe havens, so they will invariably look to buy Swiss franc and Japanese yen, and that in itself becomes a great indication of understanding the sort of risk sentiment of the market at that moment. If you're seeing particularly the Swiss franc and the Japanese yen are very strong, well, that's just showing that the people are a little bit fearful. People are a little bit not they're nervous about the particular state of the markets, and so they're looking for a safe haven in which they can move into very quickly, very easily, very cheaply, and be able to sort of retain value or increase it during during that particular period of market volatility. So, and interestingly, Japan, owns over $3 trillion more in foreign assets than foreign investors own in Japanese assets. So there is invariably, as I said, it's that kind of surplus that's created. So that just makes it very, very popular, okay, in terms of, Japanese yen being a safe haven when markets have a bit of a downturn. And yeah, as it says there, it makes it the world's #1 creditor nation. Okay, so they have enough money to pay their bills, all right, and that's what kind of people want when they're going to be, going to be placing, considerable sums of money into a safe haven asset like the Japanese yen. And it's also, it's a case of, it's become a bit of a self-fulfilling prophecy. As I said there, what you will see is that, markets will sort of jump and move towards, okay, particular currencies, okay, when they start to see that there is a particular, stress in the markets. And so it has become a bit of a self-fulfilling prophecy, which we'll have a quick look at later. So, in conclusion, ladies and gentlemen, safe havens offer protection from market downswings. Precious metals, currencies, defensive stocks, and more have been used as safe havens in the past. However, you should be aware of which safe haven is preferred for the particular crisis. If you can identify order flows into safe havens, then it gives you insight and therefore provides an opportunity. So why don't we have a little look at some live markets and just get an understanding of what's been going on over the sort of preceding 6 to 9 months that we've been experiencing. That might just give us an insight into where the money has flowed. So, as always, ladies and gentlemen, appreciate that people like to have additional support, beyond the webinars. So, we suggest you always is that come and join us in the Trading Spotlight community on Traders Yard. You can see it there, tradersyard.com/group/312. You'll see myself. I'll be in there for the rest of this afternoon. Okay, so if you have questions, come and join us and ask away. And my colleagues Marcus and Jens, they're always placing some fantastic material on there that you can utilize to help you with your own trading and education and journey. And as always, don't forget to join us next time. So next session will be on Wednesday, where you'll hear my colleague Marcus. He's going to talk about stop losses versus trailing stop, including what's the difference between stop losses and trailing stop, what are the pros and cons, okay, between stop losses and trailing stops, how to use the stop loss and trailing stop in real-time examples. So, that will be available on 2 o'clock London time on Wednesday, 9th of September. Check your inbox for the webinar link, ladies and gentlemen, and, you can sign up as always on that particular link. As always, what you'll do is you'll find that there is plenty of additional analysis and education and resources and tools on the admiralmarkets.com website. So please feel free to go there and avail yourself of those additional resources. And also, if you want to contact us, well, you can get in touch with us at, we've got here, global@admiralmarkets.com, or you can watch this and the rest of the Trading Spotlight webinar archive on youtube.com/admiralmarkets. You can look at it on facebook.com/admiralmarketsglobal. So I hope you found that useful. I hope it's just given you a little bit of insight into what we see there in terms of what are safe haven assets and how you can start to sort of make you aware of them and be aware of actually when we start to see order flows. If you just bear with me, we've got a 6-7 minutes left. So what we'll do is we'll switch across to the charts and we'll just have a little look at a couple of the major sort of major safe havens, and we can sort of just discuss what has actually been going on there in terms of where and how those the sort of we had order flows in there and what you could be looking for as a particular trader investor. So if you just bear with us a moment, we'll switch across now. Okay, so here we go. This is the Admiral Markets MetaTrader 4 platform. What I've got it actually on here is I've got it on a Swiss franc here, okay, Swiss franc profile, so we can see it against the sort of the majority of of the other majors, okay. And Sandra says, thanks a lot. This talk helps a lot to understand the havens behavior during this crisis. That's great, Sandra. It's really great to be able to help you. Okay, that's what these sessions are for, just to really help you, give you a little bit of insight, a little bit of education. So as I said, you can start to sort of utilize them as, instead of them seeing them as threats, actually be able to start to understand how you could actually utilize them as particular opportunities. So that's great. Thanks, Sandra. Thanks for the feedback. It's great to hear that, and keep joining us for extra help. So as I said, we've got Swiss franc here, and as I remember we said there, Swiss francs is a very popular safe haven currency. I'm just going to move myself out of the way. A very popular safe haven currency, so that what we see is when markets start to have those little bumps, when markets overall have a little bit of downturns, well, then we start to see money flowing into the Swiss franc. And I talk about in FX markets, I'm always looking to, wherever possible, I'm looking to sort of buy strength and sell weakness. Well, if you look back at the kind of start of this particular period, all right, so with 2020, we go back to start of the year, we'll just start to think about, well, what do we think, would have happened to the Swiss franc when, we start to see, really the COVID, the COVID pandemic start to take hold, not only globally, but in across the risk sentiment of major markets. And if we have a look here, let's have a particular look here. This is just the Canadian against the Swiss franc. This is the weekly chart. Okay, so remember every candle here is a equivalent of a week's trading. And so what we have here is this, these vertical lines that's showing us coming into 2020. And you can see for last year, okay, the CAD against the Swiss franc was, for the most part, just kind of range bound. But what we saw is in the middle of February is you can just see how we actually just absolutely collapsed there, didn't we? Okay, we collapsed there from from highs at, what was that, 74.45. okay, we went to lows at 66.05. So you're talking around about 800 pips there in the Canadian against the Swiss franc. And just think about that. Okay, what was going on there? What was going on in the world? Well, Canadian dollar is it's a commodity currency. Okay, and what we had was, if you might remember at the time, is that the price of oil was dropping rapidly because we were getting prepared to go into lockdown. Okay, so people aren't flying, people aren't driving their cars as much, and so invariably the demand for oil dropped drastically. At the flip side of that, okay, as people started to get worried about what we thought was going to really happen with COVID, well, then invariably what we had was a great deal of money flowing out of the Canadian dollar into the Swiss franc. So we saw very quickly a real collapse there. Okay, so if you're a savvy trader, a savvy investor, you'd have been able to recognize that as the oil price dropped, as the commodity dollar currencies got hit by the effects in China, as they became weaker, well, then the Swiss franc was becoming stronger. Okay, and as you can see there, in just a matter of what, about 4 weeks, 4 or 5 weeks, we had a sort of an 800 point move there, 800 pip move there in the Canadian against the Swiss franc. And you can see that we've had a little bit of a bounce back, okay, but still the markets aren't overly convinced, and if we look at some of the others, we'll get an indication of that. If we look at, let's have a little look at, the dollar against the Swiss franc, okay, and we've talked about, some people would see the US dollar as a bit of a safe haven there, but what we can see here is, once again, this is the weekly chart. We've come into 2020. We had real kind of sort of real elements there, okay, real swings there, real volatility there. But what we've seen, okay, over the last few months is a case of dollar weakness, but real Swiss franc strength. Okay, as the prices are drifted down there, we've seen real sort of strength in the Swiss franc and weakness in the dollar. Remember, that's what I'm looking to do as a trader. I'm looking to buy strength and sell weakness. And just as an aside, you might want to have a look at having sort of drifted down. Well, last week, we printed what is here is a double bottom and a bullish engulfing key reversal candle. You might want to have a little look at that. But that's kind of an interesting tale that we saw. The Aussie against the Swiss franc was the same here. Let me just bring this up. We can talk about the weekly chart. What we saw initially was just an absolute collapse in the prices there, okay, from around about 66 down at 53, okay, so 53.50, so 1250 pips there, okay, move. But what we've also seen is that as China believed itself to come right spang out of the COVID, well, then invariably people started to reinvest in China, and then people would have put money into the Australian dollar. And what we've seen is for example, the Chinese buying copper up at very cheap prices, and that has had an impact on Aussie dollar. But during the start of the COVID crisis, we saw money flooding into the Swiss franc, and that's one thing we want to be aware of. We can also have a look at, whilst we're on here, chart, we can have a look at gold. Okay, this is the weekly chart of gold. Now, let me just bring this up here. Remember, we talked about gold in itself being a safe haven, natural safe haven, and we started off in 2020. And a little bit like the dollar Swiss franc, actually during the start of COVID, we actually had price push up, but then drop down, and you'd be like, well, actually, hang on a minute, Paul, why would that happen during the start? Why would actually gold go down during the start of the pandemic, and the start of the actual market crises? Well, actually, the reason is that, invariably for what I've seen in the past is that when that market panic sets in, is that you'll find institutions have to basically start selling all of their positions, okay? And they have to sell. They might have been making money in gold, but they have to sell those gold positions to eventually ensure that they are able to cover their own losing positions, so that they don't get a margin call and taken out of business. So when the start, happens, people just rush towards, the exits. They just basically want to get liquid. They might have to actually sort of just close down, even winning positions in gold. But what we can see is that, after the initial panic, well, then hopefully you can see, after we drop down here to about 1450, okay, in March, well, we've just had a march in gold there, haven't we? We marched there from, as I said, from the low of the year, 1450, up to above 2070, okay? And I've talked about this a fair few times, but you can just see it there, okay? That has just been money flowing into the safe haven of gold, okay, for various reasons, and that is what has actually sort of just driven a huge element there, which you can hopefully see there. So as always, I'm afraid we've run out of time a little bit there, ladies and gentlemen, but I hope you find that useful. I hope it just gives you a little bit more flavor, a bit educational insight into what safe and havens are, which particular element, which particular instruments are particular safe havens, and just looking at these charts here, as you start to see during big, market sort of volatility during tumultuous times, how money flows into those safe haven assets, okay, and how you can utilize that now as an opportunity for yourself rather than a threat. So thanks for joining us, ladies and gentlemen. As always, I wish you the best of success in your own trading. Please join my colleague Marcus on Wednesday. I'm going to be in the Traders Yard room for the rest of the afternoon if you want to come and have a chat. And I look forward to speaking to you next Monday, ladies and gentlemen. Take care and trade well.